All right, today we're going to crack the code on a company's real financial health. I want you to forget about that big profit number you always see in the headlines. Just for a moment, we are going way deeper into the statement of cash flows to find out where the money actually comes from and where it goes. So let's kick things off with a question that honestly stumps a lot of people. Is it possible for a company that's reporting millions in profit to actually go bankrupt? It sounds completely backward, right? But the answer is a surprising and absolute yes. And the reason why is all about the gap between profit on paper and actual cash in the bank. You see, a company has to pay its employees, its suppliers, and keep the lights on with cold, hard cash, not with an accounting entry called profit. So how in the world do we track that real money? Well, that's what we're here to do. We're going to use a tool called the statement of cash flows to uncover this hidden story and really see how cash moves through a business. This really gets to the heart of the puzzle: profit versus cash. An income statement can show a huge profit, but hey, if your customers aren't paying their bills, that profit is just a bunch of IOUs. The cash flow statement, though, it cuts right through all the accounting jargon and shows you what a company actually has in its wallet. So what exactly is this thing? The easiest way to think about it is like a bank statement, but for a whole business. It tracks every single dollar that comes in the door and every dollar that goes out, and it perfectly explains how a company's cash balance went from point A to point B over a certain period. Now, to make all this easy to understand, the statement is broken down into three main sections. I like to think of them as the three main fountains, or sometimes the three main drains, of a company's cash reserves. These three chapters tell the whole story. You've got cash flow from operating activities, investing activities, and financing activities. Put them all together and you get a really clear picture of what the company's been up to. First up, operating activities. This is the engine room. This is the cash a company makes from its core business, the thing it actually exists to do. For any healthy, established company, this number must be positive. If it's not, that's a major red flag. Next up, investing activities. This part of the story shows us how the company is planning for the future. Is it spending cash on new factories, buying up new technology? Here's the interesting part. For a growing company, you often want to see a negative number here. It means they're putting their money to work to get bigger and better. And finally, we have financing activities. This section is all about how the company is funded. Is it raising money by taking on new loans or by selling more stock? Or is it maybe paying back debt or giving cash back to its owners through dividends? This tells you how they're fueling all that operating and investing. Okay, let's zoom in on what most analysts will tell you is the most important section of all: the operating activities. This right here is the true pulse of a company's day-to-day financial health. Now, what's really interesting is that there are two ways to get to this number. There's the direct method, which is super simple. It just lists cash collected and cash paid out. But almost every company uses what's called the indirect method, which cleverly starts with net income and works backward to find the cash. So, how does that indirect method work? Well, you start with that net income number from the income statement. Then you add back expenses that weren't actually cash, like depreciation. I mean, you didn't write a check to depreciation, right? It's just an accounting entry. After a few other tweaks, you adjust for changes in working capital. That's money tied up in things like inventory. And just like that, you've turned accounting profit into real cash. Okay, so a company is making cash from its operations. Fantastic. But what does it do with that money? That's where our other two sections, investing and financing, come in. This is where we see the company's grand strategy unfold. Let's do a quick thought experiment. If you see a big negative number under cash flow from investing, is that a bad sign? Your first instinct might be to say yes, but not so fast. For a company that's trying to grow, this is often a great sign. It means they're not just sitting on their cash, they're investing it heavily in things that will fuel future growth. The financing section is really what completes the entire story. It tells us if the company is funding all that growth by taking on more debt or by selling more shares to investors. And it also shows us if a company is mature enough to start returning cash back to its shareholders, maybe through dividends or buying back its own stock. Now, here is a really important detail, especially if you're looking at companies from around the world. Accounting rules aren't the same everywhere. Under US GAAP, which is the American standard, interest payments are always considered an operating activity. But under IFRS, the international standard, companies get a bit more choice. These little differences can actually change the story the cash flow statement tells, so it's super important to know which rules a company is playing by. So we've cracked the code on what the statement is and what its parts mean. Now for the really fun part. How do we actually use this information to make smarter decisions as analysts or investors? Let's talk about putting it to work. At the end of the day, the one question we really want to answer is this. After the company has paid for all its day-to-day operations and after it has made all the necessary investments to grow, how much cash is actually left over? That's the real prize. And that question leads us straight to a hugely important metric, free cash flow to the firm, or FCFF. Now, don't get bogged down by the formulas on screen. The big idea here is simple. This is the total pile of cash the company has generated that's available to pay back all of its investors, both the lenders and the shareholders. But if you're a shareholder, you probably want to know what's in it for you, specifically. And for that, we can drill down even further to free cash flow to equity, or FCFE. This is the cash that's left over for stockholders after all the company's debts have been handled. For an equity investor, this is the number that really truly matters. And finally, we can use cash flow to measure risk. These two ratios are incredibly powerful. The debt coverage ratio basically asks, could the company pay off its entire debt with just 1 year's operating cash? The interest coverage ratio tells us how easily it can make its regular interest payments. The higher these ratios, the safer the company is. So, when you look at a company, all of this analysis helps you answer the ultimate question. Is this company actually built to last, or is it just built for show? Because that's the real power of this financial statement. It doesn't just count the money, it tells you the story of the business, the real story, the one that happens beyond the bottom line.